41.60. So, you know, and this is where we decided to get out last month when we were into options expiration. And that's why we got out. It just happened. The portfolios were expiring. We were back at the week bounce line. I didn't see a good enough reason that we would go back up to the next level, based on obviously the fact that we just had this banking crisis and we were heading into earnings, and it was more likely that we would go this way again than this way. So obviously it's easier to just take the money and run here. And again, and I can't stress this enough, this is a very important point that I think people don't quite get about timing and exit in a portfolio. Is you know, as a value investor, we have a very huge advantage because we know where the top is. Technical traders and momentum traders have no clue where the top is. We know when we're going to go to the top before we get to the top. And that means that we can start taking money from people who are willing to bet that it's going to go higher. That means we're selling at a good price. So, you know, that's the best place to buy. And the same when we do the same thing when we buy. When we buy, we know where the bottom is, so we buy at the bottom. Now, it might not be the dead bottom and we might not sell at the dead top, but we generally have a pretty good idea of what the value is. So we buy at the bottom and we get good prices, and we sell at the top and we get good prices. And isn't that the whole point? You know, it's the market joke that you learn early on is when they say, yeah, buy low and sell high. That's the trick to the market. And everybody's like, well, what? That sounds good, but how the hell can you possibly do that? Well, this is how you do it. These lines have not changed for well, I'm pointing at it with a stick. These lines, I have a little stick in my hand, so these lines have not changed since it was the year of the crash. So 2020, in the fall of 2020 is when we started using these lines. And we determined what the value of the S&P should be in 2022. And the end, so the end of 22 prediction was here. Now, at the end of 2022, which was pretty recently, we looked at all the numbers again, and I said, there's no reason to change these lines. I said, if anything, they're a bit optimistic based on the current market conditions, based on what the earnings are. It's not some black box mystery. And we're going to get into this again as we build our new portfolios. The point is, things have a value. And like, let's take SoFi, right? We were just looking at SoFi in the chat. So let's see what I said. So here in the watch list, this isn't great. It's alphabetical. We can see what's going on. We can see what we said in the past. Very, very useful. You should absolutely have a watch list of your own. And I don't have SoFi on the watch list, so that's embarrassing. I bet I do now, though. Hang on. I'm going to refresh it because I've been updating the watch list. I updated more of, oh, there it is. See, told you. I updated more of the watch list this weekend, but then we had a lightning storm and I lost like a few hours of work, so I was really pissed off and I didn't get back to it. I was too angry to like get back to doing the work I just spent hours doing. But I'll get it done before we start filling the portfolios. There's not that much to go. SoFi. Okay, so here's SoFi. Here's my comment from the weekend, probably. I said, still not getting respect at 623. That was up here, which is 5.8 billion, but they're growing revenues at 25% and should start making a profit next year. Now, what do I mean by that? So today in chat, and please remind me when the Fed's coming up. We don't want to miss that. So then today, Control F, SoFi. So Monkman asked about SoFi. And I said, you can't stop people from panicking. They just raised guidance to $280 million, which is the top of the range, earnings guidance. And at 478, is it still 470? Why do they keep getting weird numbers? Yeah, 470, close enough. So at 478, the company's valued at 4.5 billion, which is 20 times 280, right? So 20 times 272, wait, actually it's less. So 225 would be 20 times. So it's better than that. So 20x is very low considering their growth. And notice that then echoes back to what I said when it was at 678, and I said it was probably about 25x forward earnings. So yeah, it's still in the same place. Nothing changed. They reiterated their guidance. They actually raised it a very tiny bit. And volume of origination was up 7%. On the strength of personal loans, which jumped 50% to $3 billion. That's not a small amount, right? What killed them was student loan originations dropped by 47%. And that offset it. And that's because who's going to refinance or initiate new student loans when you don't have to pay the old ones? That's what's going on right now. Nobody has to pay their student loans right now. Everybody's being forgiven. So SoFi's a big part of their business was handling student loans. Mostly what they were doing was refinancing existing student loans and helping people lower their debts, right? But you're not going to help people. That's what it means by originations. They still have the refinance loans, but what they don't have is new people, because who needs to refinance when you don't have to pay at all? But that will change. And they will go back into that business, which had been very, very profitable for them. But it doesn't hurt them that student loans are not currently being paid, other than they can't initiate new student loans. So instead, they've pushed their efforts into personal loans, and that's jumped 50%. And by the way, 50% to $3 billion means it went from 2 billion to 3 billion. Student loans dropped from 1 billion to 500 million. So all their numbers would be gangbusters had not student loans been knocked out for things that were not their fault. So when I'm looking at a company and I'm valuing it, and something extraneous happens that is not their fault, I'm going to be very forgiving. But I'm also going to consider, well, is this a permanent extraneous event that's going to completely change the company, or is it a temporary extraneous event? This is temporary. People will go to college. They will borrow money. We are not going to make all college free. Therefore, there will be student loans. Those loans will be repaid. You know, student loans do not cover all of your college. So there's a lot of ways to slice and dice it. The most important thing that happened to SoFi happened last year. They became a bank. They got their charter. So getting the charter is good in a couple of ways, because it also, what the hell? Oh, that's not what I was looking for. So, you know, getting a charter basically has this effect on the bank. But right now, everybody's sort of down on them. They're down on financials. Everybody's is very negative towards any sort of mention of anything that's not great. Do we have another thing with SoFi here? No, okay. And then if we go over here, we take a look at the bank. Or they're not a bank. They don't like to be, they're not really a bank. Although they have a bank charter, but they're not really a bank. They're an online financial company. So in other words, they would have grown faster but for the student loan thing. But meanwhile, and where did it hit them? Right here. I mean, it hit them basically between 2022 and 2023. They've gone from 443. There was a crash in the market, 566, 985, 1,500, right? 2,000, even with the problems with the loans. And next year they expect 2,500, 25% growth. Profits, there were no profits. No profits now. There will be profits next year. These are net profit, not EBITDA. There will be profits next year, and eventually they'll start crawling down bit by bit to the bottom line. And we don't need to get very far to justify this valuation. Net debt doesn't really matter with the bank. It's assets over debt and whatever and liabilities. But basically their book value is $5.2 billion, and yet you can buy them for $4.6 billion. That's too low. All right, and they don't have the risks, they don't have the problems that the other banks have, they don't have all these notes and things that they're going to take a loss on. So it's underpriced. It's not a matter of like, this is not something that's underpriced for today. This is a long-term play. This was originally from our Future is Now portfolio, but over the course of the next decade, I expect this thing to be a good bank. It's a good idea. It's a good system. And if they grow at a decent clip, they will be worth $10 billion, $20 billion down the road. And that's what the purpose of buying it now is. You can't buy everything you can, but I mean, you can't buy everything because it's going to go up next week. Some things you want to buy early, like it's like Apple or Amazon. Look how long Amazon didn't make money and people put up with it. Amazon didn't make money forever and people kept buying it. And eventually they got rewarded. Tesla too, right? Tesla was losing billions and billions and billions of dollars. They still have 2.4 billion in cash sitting around there in good shape. So on the whole, I like them. I think they're a good value stock. 487 is a silly price. So we went on to talk about that. If I can find it. Oh, because this was from Monkman, and he was talking about his position. And I said, look, his position happens to be the 410 spread. And he originally picked it up for, what is that, 220? So he picked it up for 220. Forget, obviously, he picked up for 0 because he sold the puts, right? But those puts are aggressive, and he's gonna be in trouble if they don't come back. But assuming if they do come back, it's a net 0 spread. He's in the 4s. And I said to him, though, if I have this kind of spread, I'm not going to be complacent if I have all right, so if I've got the 4s that are now, let's say 227, and these guys are 277, the 3s. So what does that mean? It means it cost me 50 cents to roll $1 down. Why would I not do that? I mean, if I'm long on SoFi and I believe that it's going to go over $4, then anything I put it below $4, not below 4, above 5, if I think it's going to go back above 5, then any amount that I roll down, I expect to be in the money. So if it costs me 50 cents to roll $1 down, why would I not do that? It doesn't make any sense. If I'm not willing to spend that money, I shouldn't be in the stock. Okay, it's like, it's like when you go to the grocery store, right? And there's 4 oranges for, let's say $2, and then 6 oranges or 8 oranges is $3. And you go, well, it's twice as many oranges, but it's only $1 more. So I'm getting a 50% discount on my next 4 oranges. This is pretty simple math, right? If I'm going to eat the oranges, why on earth would I not do that? Now, maybe you don't have room in your refrigerator or whatever, but you know what I mean. And that's true here if you don't have room in your portfolio, but you know, hard to imagine you don't have room for spending that much money in the portfolio. It's only, I mean, you're talking about, in his case, he had 25 contracts, so 2,500 would be $1,250. But the point is, if you already have the 4s and you believe it's going to be well over 5, then why would you not spend 50 cents to make $1? And so once I'm here, then what's the obvious question next? Do I spend 50 cents here to make $1? Well, I can't, because this is 75 and this is 40, and that's a bigger number, 65 or something like that. So no, I won't spend 65 cents to make $1, but I sure as hell will spend 50 cents to make $1. That is generally my cutoff. If you own any option and you're not willing to spend 50 cents to make $1, then you don't have enough faith in the spread to keep going. Why do you even have the spread in that case? It makes no sense. Everything in the spread says you think it's going to be over 4. So your chance to roll from 4 to 3 on the calls for 50 cents should be a lock. There should be no question in your mind that that's a good deal. So, and if it falls further, then you'll get another chance to roll from the 3s to the 2s for 50 cents. And if it falls further, you can go from the 2s to the 1s for 50 cents. And again, if you're not confident doing that, you have to rethink your whole position on the stock. So we think that this is an aberration caused by the financial collapse that took them down to here. They were recovering nicely because people were realizing that that wasn't really affecting them, plus the bailout and everything else. Like SoFi has no accounts that are above the FDIC limits. So, and the government has guaranteed all accounts now. So there's really no reason for anybody to panic out of SoFi. You know, not that they won't, but they could, but not likely. But anyway, so even when all the banks were falling apart, they held 525, and then they went up pretty quickly. So now, based on what? Based on just a general panic in the financials that we've had in the last couple of days and their earnings that people are taking extremely negatively, they dropped back to $5. It's wrong. Now, I would say buy back the short $10 calls, right? He's got these short $10 calls, but they're still 75 cents, I think. Let me see, where are they? Yeah, they're still 75 cents. That's a ripoff. I wouldn't pay somebody 75 cents for the $10 call, so why would I buy them back from this guy? There's no sense in doing that. If I'm going to spend 75 more cents times 25, right, which is 75 times 25. So if I'm going to spend $1,800 more, I would rather, obviously rather, do my roll for $12.50, right? I don't need to buy him back. I can just roll lower and make money that way. Or I would just buy more of, or I could spend more money on more 3s. Just buy whatever that is divided by, what do we say it is? 275 divided by 2.75 is 6.7. So I could buy 7 more longs with that money also. Because, you know, and again, it's always got to think both sides of this thing. You have to say to myself, would I buy these for $10? I mean, I'm sorry, would I buy these $10 calls for 75 cents? They're freaking $5 out of the money. What kind of idiot would buy those? Well, then therefore, I'm certainly not going to close this short call. That's buying them. I'm buying them. I'm making that bet. This guy already made that bet. He paid, not me, he paid whoever the hell it was, Monkman. He paid Monkman $1.44, and now they're 75 cents. So why would I let him off the hook by buying him back for 75 cents? They're completely worthless. They only haven't expired yet, but they're worthless. Now, if SoFi goes to 10, you're not going to make as much money because you're going to get called away at 10, but you know what? That's fine. And that's another thing. You have to learn to be satisfied. You can't maximize everything. And especially if you're going to spend money to maximize everything, because you're only just increasing your risk, You always want to try to decrease your risk and take money off the table. That is your primary goal. Decrease risk, take money off the table. If you're not doing that, you should think really, really, really hard about what you're doing. And again, we're going to start rebuilding the portfolios. We're going to be focusing on these super fundamentals because it's been 3 years since we had new portfolios and focused on these things like that. You know, there's a cycle to these things, and it's like it's good to refresh and remember why we get into stocks and how we get into stocks and what the logic is. But again, valuations, right? So let's go to my friend Microsoft if we can. There you are. New topic. What category is SoFi stock in, and what is the average PE multiple for similar companies? The average PE for fintech companies is not easy. I know it's not easy to find. That's why I'm asking you. The EV revenue? No, that's not what I'm asking for. Okay. Well, that's interesting. Okay, I'll accept that. Overall, how does SoFi compare to its peers? Curious what he thinks. So they're kind of unique, so it's sort of hard to pin them down. He's very slow today. Wow. All right, we'll have to get back to you, I guess. What the frick? Oh, no, he's answering. My fault. Oh, that's fun. I apologize. He was doing a hell of a job down here. SoFi is a diversified fintech company, has a bank charter, allows to take deposits to generate its own loans without having to partner with another bank compared to fintech peers. Upstart Lending Club, SoFi's unique advantages. Well, this is my pitch. A vertically integrated platform that provides a one-stop shop to the members, loyal, engaged customer base. It has a high retention rate, cross-buying behavior. They're appealing to kids. They're appealing to college kids and young kids, and they're building a base. And it's a brilliant strategy. 2.9 million members in Q3 21 is ridiculous because it's the wrong year. Scalable, efficient technology structure. That's another thing that drew me to them. And strong brand recognition and reputation. And again, we're old. Most of us are old, and we don't have that thing, that recognition. But I know my kids know who they are. Highly competitive regulated industry. The dependence on macroeconomic factors is what's killing them now, right? And the high debt level. SoFi had $6 billion in debt as of Q3 2021, mostly related to personal student loan warehouse. That's fine, though. That's in line with what they're doing. And the bank charter, getting the bank charter makes all the difference in the world. It's interesting, though, that this response is a mix of knowing that they had their bank charter, which happened in the middle of last year, 1 year ago today, basically. So they got their bank chart a year ago, but it doesn't know that it's 2023. And it starts giving you from 2021. It's ridiculous. But that's the problem, because even Bing is based on ChatGPT, which was trained up until September of 2021 with data. So it doesn't dig into new information unless you remind it. And I forget to remind it all the time. You have to constantly say, it is this, today is May 3rd of 2023. I need the first quarter of 2023's numbers. If you don't do all that, it just gets it screwed up. It just starts drifting off into different things. Because for some reason, they don't tell it. You know, they build all these guardrails, but one guardrail should be, today is this. Use information current to this day. You know, that should be one of the primary things it goes by, is what's today's date. Don't answer questions about 3 years ago. So let's see. So Andrew says, Generac, ha. Another thing we talked about, generally, generation, general, what? Oh, I probably only use the letters. GNRC. Oh, yeah, see, I didn't say anything about it. So Generac, no, that wasn't what I meant. What? Wait a minute, did they fall again? Oh, that's crazy. GNRC. No. I don't know what that chart is. Maybe it was a frozen chart from that date. So Generac had a huge pop today, not this. Oh, here it is. So what is this? That's interesting. Oh, I know why. It probably used the chart on that day as the main picture for the page, and on that day, that's what it looked like. So it was just falling under 100 there. And again, this is why being a fundamental investor pays off, right? Because you look at that chart, and TA people aren't going to buy it, and momentum people aren't going to buy it. But this was the day I sent out a top trade alert saying buy it. And I got into the, I mean, you guys can read it. It's one of the top trade alerts recently. And they just had earnings today, and they popped. This is all today, though, $13, $14 today. They've been drifting along until the actual earnings, because people don't know how to value stocks, and they don't understand the companies. And by people, I mean the top Wall Street analysts. They don't understand companies, and they tend to sort of basically they pigeonhole things. They just go, oh yeah, I know all about it because I'm a genius, because I've been doing this for 40 years, therefore this and therefore that. They don't understand specifically how a company works. They've just got their things that they know and their prejudices, and from the time when they were poor and they used to actually do work, right? When they were on the trading desk at Goldman Sachs, that's what they know. That's what they understand from 20, 30 years ago, what the situation was for these kind of companies. And now they say, oh, I'm an expert in this. Therefore, they don't study, they don't read the reports, they don't get involved, they don't know what they're doing, and they just make sweeping generalizations. And unfortunately, then they get interviewed on CNBC, and then the current analysts, who are also a bunch of idiots. And this is a big problem, though, because you're not trained the way you used to be trained as an analyst. Analysts now are people who blog. That's basically what analysts are these days. There are good ones inside the trading houses. The younger ones are inside the trading houses, but there's no the old back and forth. It used to be an apprenticeship thing. You would go to a trading desk, you would work your way up, you would become an analyst, you would learn, you would talk to the older analysts. You would gain from their experience, but you would also bring along your experience as a younger person, where you know more about maybe some aspects of it. And people would be pretty, you'd be getting pretty sharp guys. But the breakdown is coming, because those guys from my generation, and even maybe the generation, even maybe 20 years younger, even the 40-year-olds, you know, you get out of that and you get into a hedge fund, or you start doing something else, and you don't tend to read anymore. You know, I'm an avid reader. I like sitting around studying stocks. That's my favorite thing to do. I like that more than being on a yacht. So, you know, when I'm on a yacht, it's sad. When I'm on, you know, when I'm on, I don't go on yachts a lot, but when I go on a cruise ship or something like that, I take my computers and I sit down and I get a comfy chair and I look at the stocks and I look at earnings reports and I look at the, you know, company, I look at conference calls and things like that, and I read through stuff, and I read, as you know, every day I read magazine articles and everything. I'm into learning about new things, and I don't believe I know everything, so I'm constantly checking things out. But this is a gap. This doesn't happen anymore, because now so in other words, the 40-year-olds now, the people who are 20 years behind me, they came up as apprentices basically in the normal system, in what used to be the normal system, but now the people behind them, there's nobody at the desk. They're all working at home and blogging and Googling and chatting back and forth and whatever and having virtual meetings. It's not the same. And you don't get that constant feedback. That's the most important thing. The guy who's 40 years old, who's moving off the trading desk and is moving into like managing a fund or something like that, that guy should be talking to these young kids. He's not. He's emailing the young kids. He's interacting with them once a week or something like that. It's not the constant everybody's in the same place, you know, getting things done kind of attitude where everybody goes back and forth. And people say, I understand this. And then the guy's like, no, you don't. And then the kid's like, yes, I do. And you have an argument. And then you sit down and everybody has to prove that this is a healthy thing. And that's why New York, by the way, is the center of the universe for financials, because it's based on argument. You know, you have to be able to not politically argue, it's economically argue, and that's respectfully. You're going to see a lot of people on the trading desk. They'll call each other's assholes and they'll make bets. They make bets with each other all the time. But the point is, you argue the crap out of your position on a company, and the other guy argues, and you end up exhaustively researching it to prove the other guy wrong. And then eventually you come to a consensus and be like, okay, because somebody's going to get lunch over this thing. And that's a great environment. That's a great way to hone opinions on how things work. And we don't do that anymore because there's no group of people sitting in an office. And so generally, people don't know how to value companies anymore. Very, very few people understand it. Very few value investors anymore because it's too hard. It's too much work for people to be value investors. Even though it's, to me, the easiest way in the world to make money. How much is something worth? Is it cheaper than that? Buy it. Is it more than that? Sell it. It's not complicated. Anyway, so Generac, we were very excited about buying it at 100. That's our point. That's our buy point. And I said here, it's still going to get negative interpretations from many. It's funny. It's exactly what I'm saying back here. I said we haven't been in this hurry. We haven't been in a hurry because they're spending a lot to expand. So revenues are up 12%, but profits are down 20% less. And that's still going to get a negative interpretation from traders because they don't understand what the hell they're doing. You can't punish companies for investing in the future. God forbid that. I mean, it already does catch on, but I mean, God forbid that was really the way everybody acted on Wall Street. If these companies actually avoided any kind of investments because it pissed off the traders. And I said in the poorly constructed algos. Meanwhile, though, so then I go on to explain, this is what Generac actually does. This is what the company's about. This is how they make their money. So the company's long-term growth prospects still look promising. Changes in the utility and automotive sectors create a demand for this kind of power supply for homes and businesses. A value metric suggests the stock is overvalued, but a discounted cash flow model estimates a per share value of 149, which will be a 22% upside. I said the article also mentions company's recent slowdown in revenue growth, inflation's impact on gross margins, high inventory costs, Overall, the company could be an excellent long-term holding if purchased below $100. So it went below $100 on whatever date this was, April 6th. So we got below $100, and very, very simply, I said, well, I don't feel a lot of pressure to jump into a full trade right now, but at the moment, why don't we just sell the 2025 100 puts for $25? So we sold 10 in the short-term portfolio for $25,000. That's pretty simple, right? We're willing to buy 1,000 shares of Generac for $100, $100,000, and we're getting paid $25,000 to do it. So our net would only be $75,000 if it was assigned to us, and we think that's a spectacular price for Generac. So our net entry is $75 down here. It did fall to just over 90, but again, not their fault. It was just an overall market panic, had nothing to do with them. Once you get into the earnings, boom. All right, and I said just to remind us to keep an eye on them and what we were going to do. If they went lower, we would have thrown these puts into the long-term portfolio and constructed a whole trade. If it just went up, so the short-term portfolio makes a quick $25,000 for doing nothing. Oh, and that's what I said right here. So consistency. That's it. This is the logic for building a portfolio. This is the logic for buying spreads. We look for good value stocks, and when they get to a good value, we act on them. Oh, that's chat GDP. Oh, here we are. Here's our watch list, right? So look, it's very simple. We just go through our watch list any day you want, because these are dynamic. So any day you want, you go to the watch list and say, who's still cheap? ACAM's still cheap. 83.50, 81. Okay, so we like them in. Allstate's still cheap. Nope. I mean, visually, I can see right away, right? Avgo's too expensive now. Barclays is good. Big Lots, not as thrilled with it at the moment. But the point is, you find these things that you like, and you say, okay, so now let's take a much harder look at them again. Even though we looked at them, they wouldn't be here if we didn't like them. But situations have changed, so you have to say, how much did Barclays really get affected by the crisis? And mostly, it just gave us a good price. Barclays, I think, is a really good one. BlackRock, I love. These guys I love. They're just a little basic store. BNTX is a good one. BXMT, super duper undervalued. That's a definite pickup for the new portfolios. Citibank. So you get the idea. It's so simple. It's visual. Anytime I want to buy a stock, I just can browse this. I can browse this selection of fine stocks that are on sale. They're not all on sale. They were on sale at one point where they got interesting enough for us to put them on the watch list. The intention of the watch list is if they get cheaper than this, I definitely want to buy them, unless they got cheaper because something really bad happened. But if assuming they get cheaper for no particular reason, I definitely want to step in. That's why it's a watch list. These are stocks I want to watch. I'm interested in buying. They've already passed our filters, and our filters, by the way, let's not forget, from way back in November, our filters were low debt, right? And low is a relative term, but mostly it's low debt. I was looking for companies low debt or very manageable debt. Certain companies have, like banks, certain banks, some banks will have debt, but it's manageable debt because of the way they're structured. So low debt, manageable debt. Very important, all the stocks on our watch list, a high earnings per employee ratio. That was very, very important, because my number one concern from last year and this year, still going forward, is labor costs. Labor costs are going to be a big pressure for years to come, because we are still drastically underpaying the workforce. So good PE, low debt, high employee to earnings ratio. So companies that make a lot of money per employee will not be as impacted by employee wage increases. It's a very simple concept, right? Those were major criteria, and of course, then on top, that was my filter to get down to like 1,000 companies. And then of the 1,000 companies, we have 100 here, and the 100 here are also good, strong companies with strong stocks that we expect to do well over the next few years. So that's what this list already is. Out of 6,000 publicly traded companies, these are the top 100. Disney. Now, Disney is down because they're at war with DeSantis and people don't know what's going to happen and so on and so forth. It's kind of hard to gauge what kind of damage DeSantis can really do. It's tough to operate in a state, though, where the governor wants you dead. Disney, they have parks all around the world, but this is a major thing. I mean, oh, here you go. I mean, let's ask. Okay. What percentage of revenues and profits for DIS come from its Orlando theme parks? I mean, I got to tell you, it's like the greatest time saver in the world. Now, sometimes it'll tell you things that are wrong, in which case you're not really saving time. But you know, fortunately, from my experience, I have a good idea of what's wrong and what's right. So if I see a number that's out of whack, according to the fifth search result, number 2. According to the fourth search result, Disney operates 6 resort locations around the world, 12 theme parks, 53 resorts, collection of Disney signature experiences, Disney Cruise Line. Yeah, we know. Therefore, Orlando theme parks are only a fraction of the total segment profit, revenue, and profit. There you go. That's helpful. But what I would think, except I have to say, I mean, I'm sure Disney Orlando. Annual attendance at all Disney resorts. The total attendance at all Disney theme parks is 155 million. Okay, so you see 20 million, and Paris is 5 million. I bet Tokyo is not that much more. Oh, annual. You probably could have answered it. Oh, there you go. So Magic Kingdom, 20 million. But see, here's the problem. Magic Kingdom, Animal Kingdom, Epcot, Hollywood Studios. Okay. Wait, so what's Disney? That's California for sure. So that's the thing, is it's not just 20, it's 20, 33, 35, 45, 55, 56, I say 56, 57 is the actual number. So almost 60 million people, and that's out of one. So it's a third. It basically works out to about a third of their total attendance is from Disney. But also, it's not just about attendance, because this particular Disney in Florida has massive, massive hotels all around the park. So there's 60 million visitors. There's also a huge amount of hotel revenue in this area too. Plus, they've got this place called Disney Springs, or it used to be called Downtown Disney, where everybody shops and goes to buy things and whatever. And there's restaurants and things that draw revenue from there. So it's a lot of revenue. So of the theme park revenue for Disney, this is a lot. This is a good 1/3 of it, or maybe more. So it's a very significant chunk. So, you know, is DeSantis going to chase him out of Florida? So okay, so anyway, so the theme park segment is a third of the let's go that way. The theme park segment is a third of Disney, and I would have to say that let's call 15% of the total. I'd say half of this 33% could be Florida. But it's also 64% of the operating income. That's where it gets scary, right? So 64% of the operating income, it's the profitable 33%. And that's where it's very bad. So if you figure it's half of that, it's about 30% of Disney's total operating income is coming from Orlando. And so does the thing with Ron DeSantis matter? Of course it does. They can't leave. They can't like hitch all their, it's not like a carnival. They can't put all their rides on trailers and go to Georgia. Although that'd be great, wouldn't it? Wouldn't it be great if they just took Disney out of Florida and told him to fuck off? Because you can imagine how much money Disney pays to Florida. Not to mention 60 million people. 60 million people fly into Orlando. Okay? They stay in hotels and pay the hotel tax and the food tax and everything else. So Florida's economy is based on Disney. And Ron DeSantis is pissing him off. But the thing is, what can they really do about it? If I were Disney, I would basically, I'd go buy the Astrodome. You know, Houston, that whole area in Houston that was the old Astrodome. I would buy that area and start putting my park there. And then announce that I'm going to decommission out of Florida. And watch Ron DeSantis try to run for re-election. It's really insane. I mean, it's just the most crazy thing. Oh, here's the lawsuit explained. It's very interesting. It's gonna be interesting. It's gonna be precedent setting. It's gonna be all kinds of things as it goes on. Because basically, the Disney company is now suing Ron DeSantis for what are they calling it? I forget. I mean, basically for overstay, for using his authority, for the state authority for vengeance, for personal attacks. So we shall see. But anyway, that's what's as enticing as Disney is down here. It's a little tricky. I am in favor of selling some puts. I really don't see it going much lower because, again, we know what the damages are going to be. So Disney was 180. And they've been going down, and you could say maybe we have a recession, maybe this and maybe that. But the reality is this is crazy low. If we go over to Disney, so now we have a hard number on it. So basically now we know as a hard number, if Disney were to completely shut down Orlando, it would hit them for about a third of their income. That's a worst case scenario. And that's a lot. That'd be, let's say, $3 billion. So maybe they would make, instead of making $10 billion in 2024, they'll make $7 billion. But their market cap is 183. So 183 divided by 7 is 26. All right. So the worst case scenario is going to bring us down to 26 times earnings. As it stands, they're supposedly at 18 times earnings against 10 billion here in 2024. They're 18 times forward earnings. So if we assume that this drops down to 7 billion, which is frankly where we are now, which is 7 billion. And 7 billion is way better. That's the other funny thing about it. Look, 7 billion is double last year. Right? So at the moment, they're on a 7.6 billion track. That's double last year. And last year, where's 22? January 22. So last year, they traded between 150 and 100 at least. So let's say about 125 average. So last year they traded 125 with $3 billion in earnings. This year with $7.5 billion in earnings, they're trading less at 100. But all that really matters is, let's say $3 billion gets knocked off. And again, that would be if they closed Orlando entirely. And Disney had no way of making up the revenue. The other theme parks didn't increase, blah, 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 blah. So if that happened, then you'd have to say, then we'd be selling. Well, that's an easy way to do it. Let's do 7 times 20. That would be the most logical. So 7 times 20 is going to be 140. All right, so that means it's 43 divided by 180 is 23% down. And so we say it's going to be $76. All right, 23% down from here is going to be $76. So now we have a number. And again, how hard was this? How much work did we really have to do to find this out? It's not that hard to value something. So I now know for a fact, as much of a fact as I can accept now. What are the problems for Disney? Of course, it could be more COVID. The cruise lines what killed them in the past. It wasn't the parks, it was the cruise line that killed them. So that's what's coming back and making a ton of money. Oh, and by the way, those statistics obviously included very low cruise line revenue. So maybe we're probably being too pessimistic about the amount of the theme parks effect, since we were calculating those numbers without the cruise line revenues being in there. And that caused, look at the massive loss that caused back in 2020. But of course, COVID could come back. That's always a danger with Disney. That's why we haven't really been jumping on them, except for the butterfly portfolio, because we didn't want to overcommit. And they were a great choice for the butterfly portfolio because they've been in the channel for quite a long time. But as a bottom line, though, I think I feel very comfortable with $76 for Disney. So what does that mean? That means that with Disney, I can just go to 2025 and I could say, okay, I could sell the $80 calls for $6. I can sell the $100 calls for $12.95. Is it worth taking this risk for an extra $6, $7? And I'd say yes, except I would go with a lower amount. So if I sold 5 of these for $6,000, 5 of these short calls for $6,000, I'm only obligating myself to buy 500 shares of Disney. 400 bucks is $50,000. If it does drop to 70, which is, again, very unlikely, aside from the fact that I can easily roll the short calls out to a longer year and not even get the assignment, all I end up with is net, well, let's say this is $12.50, so net 87, net $87.50 would be my entry with Disney at 70. So then if I whatever double down and I say I'm going to buy more at 70 plus $87.50 for the first batch divided by 2 is $78.75. Now again, what was our target price? $76. So I can sell these with impunity because I know that my worst case is I'll end up with 1,000 shares at $78.75. So if I sell 5 of these, I'm not worried at all. Now, if I also take into account the fact that if I was rolling, let's say I had sold the 100s, right? And they're now down to $8. So what does this tell me? This tells me that if I have to roll in 2026, those $8 calls, could be rolled down to the 85, 15, so I can get a $15 roll down. So that means I'm worried because I'm pretty sure I can roll down $15 into 2026 for roughly the same price. And I will also happily double down because I really would love to own 1,000 shares of Disney for around $75. Not only that though, but even if we have 1,000 shares at $75, then we're going to sell the $75 calls probably for, it wouldn't be for this because we'd be down to 75, right? So it would be more like $20, or figure even a little lower, but $15-20, let's say. So let's say $17. So that means I'd be in for net $77. I sell the calls for $17. Now I'm in for net 60. and then I sell some more puts for $5 that are decently out of the money, and now I'm into net 55. So at $100, all I'm asking myself is, do I want to own 2,000 shares of Disney for net $65, for net $55? Of course I do. Why would I not want to do that? Therefore, boom, fine, done. That's my buying decision. I know what Disney is worth. I know, and more importantly, I know what Disney is worth. I know what it's likely to do, and I know what I would do if it does it. So in other words, the worst case scenario for Disney, I'm very comfortable with. I have no problem following and making it a decent part of my portfolio. Because even if they shut Orlando down and move to Texas, I'm good with that. I still want to be an owner long term. Could you imagine? I wonder how hard it would be to move it. You think you could pick all that stuff up and move it? You can, because it's Florida. There's no foundations. Everything's a swamp. It's not like it's built on concrete. It's not like it's built deep into the ground or anything, because deep into the ground is water. That would be too funny. Oh, the Fed. Holy crap. Who reminded me? Oh, somebody tried to remind me, but I wasn't paying attention. Damn it. I was just going to ask Bing how to move Disney. Okay, wait a minute. Clicker. TV, menu. Oh, it's off. What happened? Come back. Wall Street Journal. Oh, come on. Profile, apps. Please, I don't want to view my profile. I want to, there we go. Bloomberg. What happened?
It's still way too high. Rates is at 2%.
Did the Fed do a thing or not? Mexican peso.
We just don't know quite yet.
Mexican peso, wheat.
And we just don't know how much.
What is going on?
Michael Jason, I would talk to you about the banking crisis, but you'd probably walk off the set with a look from Mr. Moynihan, so we won't go there.
What's
Michael Jason, I want to talk to you about Fed policy, and I want to get right to it on this press conference. What will we learn about the June meeting?
what just happened? Oh my God. NATO warns that Russia is mapping EU-US critical assets. 2-year note went down. The Dow is flat. I see nothing telling me what the actual rate decision was. All right. Shut up, Bloomberg. You're useless. Economic activity expanded at a modest pace. U.S. banking system sound, resilient, tighter credit, blah, blah, blah. Committee seeks 2%, raising the target rate for federal funds to 5 to 5.14%. The committee will closely market, blah, 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 and bloody, blah, 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 blah. Wow, what a short statement. Wow. In assessing the appropriate stance on addition mortgage-backed securities provided, the committee is strongly committed to returning. Okay. All right. Well, we're going to have to go through this word by word. Okay. Economic activity expanded at a modest pace in the first quarter. Job gains have been robust. Bad forward statement in recent months. Unemployment rate has remained low. Bad forward statement. Inflation remains elevated. All these things say tighten. The banking system is sound and resilient. Wow. Well, I guess I'm going to say that regardless. Look, they did a $2 trillion bailout. It is sound and resilient. Okay, it's except that unfortunately we still have banks that are failing. The tighter credit market conditions for households and businesses are likely to weigh on economic activity. The extent of the effects remains uncertain. The committee remains highly attentive to inflation rates. That is the fourth thing they have said that indicates they're still hiking rates. The committee seeks to achieve maximum employment and inflation at the rate of 2%. Now, maximum employment is interesting because what do they mean by maximum employment? We talked about this, was it yesterday? This is a very important concept. Okay, not you. That. So what does maximum employment mean? Maximum employment, this is how many jobs are open. This is how many jobs are this is our civilian labor force. There are more jobs than we have workers by 9 million, basically. This doesn't really indicate that, but so there are 9.5 million open jobs that are not filled. I guess part of civilian labor force is always somehow in flux and whatever. So you can't say they're not all, just because it's a labor force, it doesn't mean they're all employed. But there are 9.5 million unfilled jobs. So what is maximum employment though? Is maximum employment is this maximum employment right here? Does that mean maximum employment? Probably, yeah. And if that's the case, we're not there. So the Fed can either get more people to work and fill these jobs, but as I mentioned in the article, this is very difficult because how are you going to get more people? And I've discussed the best way to get more people would be to do a national daycare program, because that would allow 20 million mothers who are home taking care of their kids that could otherwise be working to go out in the workforce. That would solve your labor problem right there. There's 20 million fairly qualified women, mostly with college educations, who are stay-at-home moms. And the main reason they're stay-at-home moms is, and not all of them, but the main reason they're stay-at-home moms is because it's more expensive to go to work than it is to stay home. That if you've got to get your kids if you have young kids, and young kids means below 10, below 11, below 12, at what age do you stop freaking out that your neighbor left their kids alone, right? 12, 13, 11, 12, maybe 12 if they come home and they go off the bus and there's no parents home. But not if they get in trouble, not if they cause trouble though, right? Only if they're good kids, then you don't complain. But if they're 13 years old and they get off the bus and they start playing drums or whatever in the yard, everybody's going to complain about that unsupervised kid. So you have to realize that the best intentions, there are many, many parents who just simply aren't able to work because they've got kids coming home from school that they have to get care of. They got kids going to school that they have to take care of, and they just can't fit it in. And if they do fit it in, getting somebody to take care of the kids, or having an after school program, which of course have all gotten cut, or having daycare facilities or something to take care of the kids, all of that doesn't really exist. And we have no plan for that in society. We don't do anything about it. We just say, tough luck, if you have a kid, you're condemned to 10 years at home. And these are college educated women, had perfectly good jobs, had to leave because they got pregnant, and then afterwards they realized it's just too difficult. And if you don't have a really well-paying job, it's too expensive to have your kids not be home with your kids. So it's just, and there's a lot of that. That's a huge problem in the labor force right now. It's just not worth going to work for a lot of people. So that's what I was talking about the other day. So the question is, what is the Fed going to do? It's very hard to, without government cooperation, how are they going to get this number up? How are they going to increase the labor force? And of course, corporations offering more wages solves the problem too, but good luck getting that to happen. So the Fed, they don't have much choice but to say, well, let's decrease the number of job openings. And how do we do that? We crash the economy. If we crash the economy, there'll be less job openings and then we're all good. Everything lines up again. But that is not the way to solve the problem. Ugh, where are we? That is today, right? Nope, that's the wrong report. There it is. All right, so they keep saying this, which is all very bad for, if you're hoping the Fed is going to be tightening, is going to stop tightening. The committee decided to raise the target rate to 5 to 5.25, and I'm pretty sure it was 4.75 to 5 was the old one, so it's a quarter point up. The committee will closely monitor incoming information and assess the implications for the monetary policy in determining the extent to which additional policy firming may be appropriate and return to 2% over time. The committee will take into account the cumulative tightening of monetary policy, the lags by which the policy affects the activity, and the economic and financial developments. In addition, the committee will continue to reduce its holdings of treasury-backed securities and agency debt and mortgage-backed securities as described in its thing. The committee is strongly committed to returning, and again, over, and this is a very small statement for them to say this frickin' again. How many times are they going to tell you that inflation's got to be 2% before they're done? In assessing the appropriate stance of the monetary policy, the committee will continue to monitor the implications of incoming information. The committee would be prepared to adjust the stance of monetary policy if appropriate, if risks emerge that can impede the attainment of the goals. The committee's assessments will take into account a wide range of information, including readings on labor markets, the thing I just talked about, inflation pressures, has to be 2%, good luck with that, and inflation expectations and financial and international development. Voting for it were everybody. Everybody voted. Nobody dissented in raising rates. Now, Bloomberg says Fed omits prior language that signaled more rate hikes ahead. I'm not sure about that. So let's see what they're talking about. Well, let's get the Wall Street Journal another chance. See if they actually got the news now. Here we go. The Federal Reserve approved another quarter point hike, signaled it could be done lifting rates after that. I don't agree with this at all. Where are you getting this from? What is this? Oh, here we go. Ahead of the meeting, stocks, blah, blah, blah. Oil prices, blah, blah, blah. Elsewhere, approved. Where did it signal it can be done lifting rates? Damn, this is bullshit. A hint that officials could pause after the latest move. They cut their phrase from their previous statement that said some additional increases might be appropriate. So instead, they've said they're data dependent, but interest must be 2%, and they repeat it over and over again. Boy, that's what they're hanging their hats on. Instead, they said Wednesday they would monitor economic and financial developments the effects of their early rate increases and determining the extent which policy firming may be appropriate to return inflation to 2% over time. So are we returning inflation to 2% over time? Now, the drastic drop in oil, we're now, and by the way, oil is now at 68.96. So the drastic drop in oil and copper's way down too this month, those are going to be very helpful to inflation fighting.
Hey out there.
Oh, shit.
Welcome in.
So annoying. All right. All 11 voters, statement used language broadly similar to how they concluded their interest rate increase in 2006. Oh, wow. We're really stretching here. That's like what they said in 2006. Yeah, but in 2006, the rates were like much higher. Officials considered skipping a rate increase in March after the failures of the banks, but they concluded to stresses the calm, the sale of First Republic Bank. Again, there's too many open jobs. Wage pressure is rising. Inflation is not below it's not even below 6% right now. So there's going to have to be some major improvements in that before the Fed is going to be done. Very interesting. So now it's going to very much depend on what Powell says, and they're going to try to pin him down into making some definitive statement. But where is Twitter, boy, Twitter is dead. Musk has really screwed this thing up. No, sign in as Philip. No, no. Is that how I'm on Twitter? I don't think so. That's not my proper Twitter account. No, that's not my regular Twitter account. Doesn't matter though for this purpose. Fed parsing. Whoop. God damn it. Gearing up to parse the Fed's decision. Latest. April 28th. This is no good. I want to see one of those things that's like line by line tells you what they said differently. I mean, smallest statement, we may as well look at the other statement. Fed opens door to rate hike pause. Fed drop. Did the Fed statement say this? No. See, this is the problem. People just make shit up and they pass it along. You said no more rate hikes. Actually, I said no more rate hikes. That's very good. I like that. Booming Discord. Aha! Wow. Wow. Okay. So economic activity expanded at a modest pace. What? Wait a minute. I was all excited, but this seems like an older one. Nope. Okay. Did I read that wrong? Oh, no, didn't want a PDF. It does say modest pace. Okay, I'm sorry. All right, so economic activity. Recent indicators point to modest growth. Now it says economic activity expanded at a modest pace in the first quarter. So modest growth, it used to say modest growth in spending and production. And now it says economic activity expanded at a modest pace in the first quarter. Job gains have picked up in recent months. And now it says job gains have been robust in recent months. All right, that would seem to me to be more than picked up. It's very tricky, right, to read these. Kind of running at a robust pace. Unemployment has remained low, inflation elevated, so no change there. The banking system is sound and resilient. Tighter credit conditions are likely. Two-way. Here it says recent developments are likely to result in tighter credit conditions for households and businesses are. Now remember, this last one was right after the crash. So basically they were right to weigh on economic activity and hiring. The extent of these effects is uncertain, remains uncertain. So no change there at all. Committee highly tended, blah, blah, blah. Okay. Rates are, and they were 4 3/4, now they're 5, and now they're 5. The committee will closely on in determining the extent to which additional policy firming may be appropriate. The committee anticipates that some additional policy may be appropriate. So so basically they were saying, yes, additional policy firming will be appropriate. Now they're saying, instead of saying that they anticipate it will be, Now they're saying we will determine the extent to which it will be appropriate, but still to return inflation to 2%. So nothing has changed. They just taken a little bit less definitive language in there, but that does not indicate a pause. I'm sorry. Then they scratched out in determining the extent of future increases in target range. So instead they have said the committee will take into account, well, they said it last time too. So wait, let's get that sentence now. Wow, very tricky. In determining the extent to which additional policy firming may be appropriate to return inflation to 2%, the committee will take into account the cumulative tightening of monetary policy, the lags, and blah, 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 blah. That is exactly what they said last time, and they raised the rates. Okay, there's nothing here about a pause, and there's nothing here saying they're not going to raise rates again. This is all a bullshit spin that's being put on it. The committee will continue to redo, and everything else from there on is the same. So it's really this teeny change in the language, which they want to leave open to interpretation. They want people to believe they're willing to lower rate, to stop raising rates. They want to see what the reaction is going to be. So now it's going to be up to whatever Powell says, okay? So meanwhile, we can have fun watching the outcome. Here's where we are now. It's as usual, after the Fed minutes, it usually goes up, and Powell usually manages to get the stocks up a little bit more, and then the next day we crash. So we'll see how this goes. I'm taking a quick break, going to get some tea, and you guys can amuse yourself by betting on which way the S&P goes. All right, back in a minute. Oh, all right, where are we? Ready for another 2 hours. All right. What's going on? Stocks hit session highs. Yay. And look at the dollar, by the way. That's how your stocks hit session highs. So you know, all that matters is what the headlines are going to say. And the headlines are basically saying now, Fed may pause. And that's what people want to hear. But that's what they keep saying over and over again. Potential pause, Wall Street Journal. So you get that, and then you drop the dollar, which can be done at will over any short period of time. The dollar can be shoved down. So they drop the dollar all the way below 101 for a minute, and that spikes other things. and it spikes the indexes. And then you say, oh, look, see, it's a rally. The Fed must be pausing. Everything is great. And it all seems to line up, right? And people sit there and look at their charts, and again, it goes back to, that's why I have no respect for chart people, because it tells you nothing. You have to actually read what the Fed did say and think for yourself. You can't just basically go by whatever people are telling you in a headline. They jumbled a few words around, but there's no change in the statement. There's no change in policy. And the fact is that inflation is not 2%. So how is the Fed done if inflation is still where it is? Do we have that stuff? Briefing. Fluctuations in top rates. Okay. So BRI, briefing.com. There you go. This week, what do we have? ISM, construction, market, productivity, trade balance, claims, non-farm payroll, blah, 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 blah. And look, they're still expecting another 200,000 jobs this week. That's nuts. This is not slowing down. I mean, historically, we used to be thrilled with this many jobs being created. That's 2.2 million jobs per year. That is a very high rate. Hang on, I want to get to other stuff before I move off that. But I mean, you just got to understand historically in context where you are. Not that. Let's find some inflation data. Next week, CPI. There you go. So commodities have been down. So this is bad though, because commodities were already down. Therefore, it's not going to have a big impact on CPI if they go down further. It's services and energy. Services have been climbing significantly. And here's the total CPI, about 5% total. Sorry, but it's a core CPI the Fed cares about. And the core CPI is over 4%, close to 6%. But the good news, since the last CPI report, that's when you got to start looking at what's going on. So since the last CPI report, so the CPI report from 1 month ago, basically here, oil was at 80, but the problem is here, it averaged. So when they got this report, because I'm going to get the next CPI report whenever it is. What did it say? CPI, May 10th. Okay, so okay, so the 10th, basically, let's say April 10th. So on April 10th, the last CPI report, right? That was going back to this month. So now we look at that and we say, well, what was the average price of oil? Well, the average price wasn't $80. The average price was more like around 75. Okay, so, and since April 10th, the average price of oil is right here, is over 75, 77.50. So right now, even with oil down here, our average today is higher than it was last week, than it was in the prior CPI report. That's not good. Now, more importantly, gasoline, again, April 10th, right about here. So April 10th was a high. The average was, let's see, between here and here. We went down, then up. It was certainly around here was the average. So let's call that the average is 275. But since here, we're pretty much averaging here is 265. Not a huge drop. You know, what's 10 cents out of 275 is like 3%, right? 4%. 10 divided by 275, 3.6%. Okay, yeah, there you go. I don't know why I check. I check to make sure. I don't know. I think I do. I have my mental glitches these days, so I do check to make sure I'm not being crazy. It's Powell. Holy cow. All right, hang on. And he's going right into it.
We released price review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review
It's talking about the banks.
to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment.
Dual mandate.
For the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation.
Strongly committed to bringing inflation down.
Price stability is the responsibility of the Federal Reserve. Without
Price stability is the responsibility of the Federal Reserve.
in particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a 1/4 percentage point. Since early last year, we've raised interest
Oh, the Dow's red again.
5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking at
He's basically reading the Fed statement.
and determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below.
Oh, God. Read the highlights. All right. Anyway, it all comes, he's going to get the Q&A matters more than what he says. All right, so that's it. So fuel, energy doesn't seem like it's going to totally help us in this situation. So what else do we got to look at as far as commodities? So cocoa's up, cotton about the same, orange juice is up, coffee is, I would have to say up. Yep, coffee's up. Lumber about the same, sugar is way up. These are bad. These are things we use all the time, right? Metals, well, gold's much more, silver's much more, platinum's much more, copper crashed. That's going to be somewhat helpful. Palladium is up. There's no help there at all. Meat, no, meat is way higher, way higher. Even hogs, way higher. Okay, so no. It's not looking good, is it, folks? Now corn crashed. That's good. Oh, that's why we have corn in the fridge. I get it. Must have been on sale. So corn crashed, soybeans down, soybean meal down, oats down, rice not too different, and soybeans again down, which is the same thing 3 times. Wheat came down, but suddenly spiking back up for whatever reason, and canola oil, but big shortage of oils out in the outside. So grains were medium, but meat, metal, soft, we're not being helped here at all. Okay, so here we go. Now let's talk to Mr. B. Okay. What are the components that make up the CPI report? And I ask it this, you want to get it on a track so it starts thinking about the right things. Otherwise, it'll just give random answers. So I'm just waiting for him to get his brain around the CPI report. Okay. The next CPI report is April 10th, 2023. But I think we can anticipate the likely outcome, the likely CPI number by taking what we know about the components over the past month and extrapolating report. Can you do that, please? Ah, he doesn't even give me an argument. Very nice. I had to do a lot of explaining to him before to tell him to that he could make a guess. He was very, very against guessing in the past. Good job. Exactly what I wanted to do. All right. Index for items. Index for all items will increase by 0.4% as it did in March. The index for shelter will increase by 6%, which is a monthly average increase. The index for energy will increase by 1%, which is the average increase. The index for food will increase, which is the average monthly increase. Using these assumptions, I can calculate the estimated CPI number for April as follows. Nice job. Look at all the math he's doing. Estimated change from March to April, 1.5%. The estimated change from April to April is 5.2%. Therefore, based on these assumptions, good job. Very, very nice. And what is the estimate for CPI? Okay, well, no, that's PPI. What am I looking at? CPI. So it was 1% and it was 4% for the core. And he's saying 1.5%. What? He must mean 1.5% for the year. It can't be, obviously, because the prior is 1%. So that would be 1.2%. He's saying 1.5%, basically. But in other words, yeah, he says the same thing I am. It's just overall, you're going to be looking at a slightly hotter number. See, and that is how we do a forecast. You know, and of course, it's not one thing, but it's things that you see. So when you see a bunch of different things that indicate, you know, I just make a tick in my mind. It's like this, you know, more inflationary, less inflationary, more inflationary. And every time I get a piece of data, I have a number in my mind. It's like counting cards, right? And I keep a running total of whether we're hot or cold going into a report. And then it's nice that I can now, you know, have this guy do, you know, run the double check for me and get me some hard numbers like this without, I mean, you know, saves me like a half hour worth of work. It's fantastic. So that's great. And the Dow is now up 40 points. The S&P is only up 16. That's not very exciting at all. The Nasdaq's up 100. But again, the dollar's down, so it doesn't matter. It's all stupid. Where's my dollar? Where's my dollar at? Oh, there it is. See? So none of this is in any way exciting if the dollar's down that much. Basically a 101. So from yesterday, it's down 1.2%. And these guys are not. In fact, we were talking about this morning what the bounce lines were, and they're all pretty much not hitting the strong bounces. So this is not particularly great. Anyway, all right, what other data is up for next week? May as well take a look, because now we know what look, the Fed is saying they're data dependent. The Fed's saying they're data dependent, and that's what they're saying. Everybody likes to think the statement's going to tell them what's going to happen. No, the Fed said they're going to look at the data. The data is indicating so far that, with my briefing, was this? No. There? No. Oh, what is the GDP now, though? That's always good to know. How are they doing for here? Ooh. So the Atlanta Fed believes that we're going to hit almost 2% on GDP for Q2. The most analysts are saying it's going to be more like 0. That's a big split. So it'll be interesting to see who breaks first. I'm not seeing it. I'm not seeing the. I would have to go with most analysts. I'm not sure where they're getting their numbers from. But that wasn't the thing. We were looking right at the. There it is. So next week we have CPI. That's the data the Fed is talking about depending on. We have PPI, also obviously the same situation. We have more jobless claims, blah, 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 no one cares, and consumer sentiment people will care about. And that's where we're going to be in this week. We're still waiting on some data. So today we had like I said, the employment change. If this carries forward to non-farm payrolls and we're at 300,000, that's the exact opposite of what the Fed wants. And what they're really freaking out about is the wages. Unemployment rate, I'm sorry, not employment rate, hourly earnings are up 3%. If the hourly earnings are up 3%, it's not low. This is very high for the last, many years. It's a very high rate of hourly earning increases. If the hourly earnings are still up around here, and the unemployment and the non-farm payroll is adding more and more jobs, that's just going to continue to put upward pressure on wages. They need to get it back down. They're trying to get it down to here to 2%. They're miles away. They're 100% off. So in what planet does that mean that they're gonna stop hiking? It just doesn't make any sense. And the earnings is where the big concern is. I'm sorry, we just talked about the earnings. But you got to look at this indicator too. When you see the average work week, I don't know if that was here. No. But when you see the average work week creeping up, oh wait, I bet there's a chart at the bottom. Yeah, there you go. Wow. There it is, work week. So work week has been very steady at 34.5. This is what they worry about, is whether if the work week hours starts creeping up, that means that you can't find employees and you're making your current employees work more. And that means you're probably paying overtime and things like that. You want to watch out for the temporary help kicking up. These are all things you got to look at when you look at the non-farm payroll and the hours. Whether so far hours have been pretty light, except for look what happened in January. Hours kicked up 0.8%. They go down 0.1, down 0.1, up 0.8. That ruins the whole thing for the next 6 months. So hours haven't come down at all. The average hourly earnings are, basically they were 4,432. This is that was an aberration in February 3. If we're going back up, that's exactly the opposite of what the Fed wants. So, these are all the things you got to keep your eye on. We'll watch them next week. We'll see what they say. But that's why, again, when I read this Fed report, I'm always thinking of the numbers, and the people who write the articles are not. They seriously are not. They don't think of the impact of the statement. The Fed saying that we're going to be data dependent is not saying we'll pause when the data is all indicating they should keep tightening. What the Fed's just doing is setting themselves up to say, this is out of our hands. We have no choice because of the data. So Powell says the financial stability tools are working well. That is hysterical. He's got a sense of humor. I got to tell you, that's a funny guy. Wow, I know he did that. I know he had that chart. Let's see. Where was that? Oh, come on. Really? I'm sure it was Tuesday. So frustrating. Oh, and that's the other thing. Look at look at the money supply. How are they fixing that? In what way, shape, and form are they fixing this? It does have to be fixed. All right, so that was Tuesday. So it must be Monday. The great JP Morgan. I will kill you. There we go. Okay. This is what the Powell financial, this is a quote from Powell right now. Financial stability tools are working well. This was the entire year of 2008 bank failures. 24, 25 banks failed for less than 3 banks failed for now. So how are those tools going? Now, you could say they are working well because we didn't completely collapse. Because in 2008, that caused a complete collapse in the markets. But what really averted the collapse was remember in 2008, nobody bailed out the banks and bank after bank after bank was failing, right? So they learned their lesson. And so in March, the 2 banks collapsed and Credit Suisse, but that didn't have anything to do with us. But I mean, it matters, but it doesn't matter directly to our government. So two banks collapsed in March, and they immediately threw $2 trillion at the problem. Immediately. TARP was $700 billion. They put $2 trillion out, and no voting, no Congress, no nothing. They just immediately went, ba-boom, here's your money. So from that perspective, I guess you could say the financial stability tools are working well because we had as big of a crisis as we had in 2008. Yet we had no actual crisis because immediately we jammed in $2 trillion to backstop everything. Now, we're not using $2 trillion. To be fair, we committed $2 trillion. We haven't used anything like $2 trillion. We only had to bill out so far $500 billion. So, big bargain. Now, that's good because we may have had to bail out $1 trillion, $2 trillion. I can't even go that. My mouth stops, of course, because I'm out of screen. So we may have had to go much, much higher. Let's see, what can we do here? Oh, here we go. So let's see, that is 2/3 of a screen, or 2/3 of a screen. So now I got to go another, let's say that much higher, basically. Yeah, that's about right. So this much higher. This is what easily could have happened. And we'd still only be at 1 trillion, by the way. So obviously the backstop, again, this is only 1 trillion, and we keep going and going and going, and we're above now. We're above the post. That's how much of a backstop the government threw at this crisis, literally 2 days after it started. As soon as they found out there was a problem, they threw money at this thing. Why? Because honestly, it cost us a hell of a lot more than that not to do anything. We learned that lesson at least. You can't play with this. Once people lose confidence in the banks, all hell breaks loose. Powell says, can't know how much tighter credit translates to rates. Wow. So, Dow's red again. So Powell just said, we don't know how much tighter we have to make it to achieve our goal. But that is not saying we're pausing. Saying we don't know how much tighter is not saying I can't wait to start loosening again. It's not really the same statement. So funny. Oh my God, this is so crazy. In principle, we won't have to raise rates as high. I'm not sure what he said as high as, but in principle, we won't have to raise rates as high. And I imagine he's saying as Volcker did, which was 10% or 15% ultimately. So yeah, let's hope not. But he's basically saying we will raise rates. We have to raise rates until we get inflation back down. That's our only focus. So they may slow down, they may pause, they may whatever, but they will keep raising rates until inflation is gone. And as I have said many occasions, to the point where I don't feel like going into it twice or again, is you can't stop inflation until you balance wages. Therefore, the Fed either has to put up with higher inflation, and they don't seem willing to do that. Of course, they don't seem willing to do that because we have 32 trillion in debt. And if we have to start paying every percent of debt we have to pay, every percent more interest we pay on our debt is $320 billion of additional interest. Every 1%. So what Powell did today added $75 billion to our debt. Quarter point hike, $75 billion more debt. That's what happens when Powell hikes a quarter point. So again, that goes back to why doesn't the government spend money to ease inflation? Why doesn't the government spend money to, again, provide the daycare so people can go to work and the wages won't go up? But instead they don't do that. And then the Fed cost them $75 billion anyway trying to get the workforce down. Instead of boosting the workforce to fill the jobs, which is good for the economy and put some money right back into the government's pocket, instead they refuse to do that because God forbid we help anybody who isn't rich in this country. And the Fed instead has to destroy the jobs so that they don't need the people who are sitting at home. But that costs the government money by raising the rates at $75 billion. $75 billion would have covered the whole daycare issue. And it would have boosted the economy, put people to work, made things, it's so disgusting. I mean, come on. Such idiotic policies. Very, very sad. I'm upset. Anyway, so this is not good though, because usually we get a nice big boost when Powell talks. And so far, people are not very impressed by what's coming out of here. Why? Because that initial headline was wrong. All right. Also, it's not going to be just three banks, and it's not three. It's First Republic's on here. It's not going to be just three banks. There's going to be a few more banks on this list, and we'll see what happens. But it's not over yet. This took a long time to play out. In fact, yeah, the first bank failed in 07, and then in 08, all of a sudden, everybody started falling apart. Don't forget, Bear Stearns was lost in this mess also, right? We had that whole thing go on. So, I mean, this is like there is disaster after disaster after disaster. You don't know who's been impacted until they realize their losses. And that's what I was looking for, by the way, in this earnings season is how much have these people realized their losses so far? So it remains to be seen, and we'll have to stay on our guard. But basically, it's a 0.25 increase. That's what we're coming out of here. But I believe that the data is going to force the Fed to continue to hike. And I still have my target. I've backed off a little bit. I think 5.5% might be enough, but that's still 2 hikes from now. And 6% was my original. I said 6% by I had said 6% would be what we needed to be at by June, and we're not at 6% by June because the next meeting. They ain't going to go 1% at the next meeting, but I expected to be at 6% by summer, and it's a pause in the summer, so we should be basically at the June meeting. We're not going to be there. We're probably not even going to be at 5.5%, but that's what I said we'd have to be at to get inflation back to 2%. And we're not there, and inflation's not back to 2%. Eventually, they're going to have to go to 6%. They can't, it's not going to go any other way. And the wages are going to keep pushing. You guys, I'm sure you've seen me do that, but I mean, we have state maps and minimum wages. There's still 30 states that pay less than $10 an hour. No human being can live on $10 an hour, on $400 a week, taking home $360, something like that. Nobody can live on that in America. Maybe one person by themselves living in crap conditions, maybe, but you're not going to, you can't live on that with a family and have a retirement account and send your kids to college. It's just not even close to possible. And if minimum wage is not enough to live on, then don't be surprised when people are choosing not to live without the wage. Doesn't make, you're not much worse off. And we just put up an article this week about it was just basically one girl, but you get the idea. There's one girl who works at I think it was a fast food place or whatever, and by the time she drives to work, it's like a Waffle House or something like that. But by the time she drives to work and gets her uniform cleaned and buys shoes and pays for gas and has to do and eats her lunch, which they charge her for, and so on and so forth, it's hardly worth showing up. What's the point? And that's what this gig economy is about, because for a lot of people, it's cheaper. It's that they're gonna end up with more money. That's what a person cares about, right? What do you end up with? What does your job do for you? And that's the thing. And then when Walmart wants to pay you $10 an hour, and you have to wear the Walmart uniform and the shoes, and you always have to be neat and blah blah blah, and they got all these rules, and obviously those rules make sense for work, but no, when you're not paying a person enough money to have hot water to take a shower. But when Walmart has to compete with McDonald's, who maybe gives people food, even though maybe not officially gives people food, but I'm sure most of the franchises, I don't know for sure. I know when I was at McDonald's, I wasn't there. My friend was a manager. So, but when he was at McDonald's, they used to always let everybody eat. And when I worked in restaurants when I was young, there was no question that you got food. It was a freaking restaurant. You might not get what you want, but you get, usually you get something decent. And hell, we used to take bread home. They used to give us all the bread at the end of the day. That was great. My family was like, whoa, big loaves of bread all over the place. But anyway, so that's what matters is what do you got at the end of the day? And when you're paying people such a ridiculously low wage, they got nothing. There's nothing to show for working. It's a complete waste of time. They're better off doing some part-time job from the house or near the house, off the books, that gives them $100 than work all week for your $300. And that's why people can't find labor. And and the thing is, people can get by, and they are getting by, maybe not well, but they're getting by as well as they would get by with your crap wages. And until employers wake up and realize this and start paying proper wages, and that will cause inflation, which will then flow through the economy. Until that settles out, you're not going to stop inflation. And that means the Fed cannot be done raising rates. Oh, and Powell's talking about that right now. He's saying wage growth is running above the 2% inflation target level. And he's saying Phil Davis is talking about that right now. So it's even. All right. So we're all on the same page. I'm listening to his conference. He's listening to my conference. That's how it works. All right, guys. Thank you so much for coming. Things are pretty much as we foresee, and we will see how it plays out for the next couple of days. All right. Take care, everybody. We'll do it again next week. Thanks. Oh, wait. Do we have any questions? Let's check. Is USB in trouble? Maybe. They're popping up on a lot of bad radars. And Brendan says, my data shows USD CPI for April 0401, 830, 5.2 and 5.5. Right. So Bing is saying it's going to run a bit hotter than that, and I agree. I mean, that's where we are. All right. Thanks a lot, guys. Take care.